So for those of you who weren't here earlier this morning, we started the conference off with the song Staying Alive. And the reason I did it was I really think it describes what's happening today in the hedge fund industry. You know, in the hedge fund industry, I think there are two different stories. I think one story is what you are hearing in mainstream media, where there's just constant stories about how bad the performance is and the fees are too high and pension funds are getting out of hedge funds and some of the most well-known hedge funds are closing down and insider trading, and it goes on. And I think the average person looks at the hedge fund industry and just assumes it's hemorrhaging assets, and it's a fraction of the size it was in the glory days, where in reality, as of today, hedge funds are probably at or near an all-time high. So, and when I talk about mainstream media, I'm not talking about the reporters here. We have a who's who of some of the top hedge fund reporters that are at this conference. You do a great job covering the industry. But I think you have to take a step back and ask yourself, you know, what's going on in the hedge fund industry? I mean, if what you read is true, why is there any assets at all left in the industry? And, you know, this is a sold-out conference. We have a lot of investors that went to, you know, top business schools, high IQs, who are allocating to hedge funds. And the key thing is that we tried to bring out with all these panels is the reason people are allocating to hedge funds is very different than what you're reading in the newspapers. I'm going to start off and talk about the three reasons people allocate to hedge funds. I'm then going to touch on some of the subjects that you're reading about in the newspapers. And the first thing I'm going to talk about is helping to reduce tail risk in a diversified portfolio. Back in September, our firm wrote a paper that we felt the risk of a major market sell-off was higher than normal. And part of this paper talked about how there's a bond bubble. Part of it talked about how equity valuations were above their historical highs. And part of that was being supported by these ultra-low interest rates. If you fast forward to today, there's been an election. Trump is our new president. And I actually think the risk of a market sell-off is even greater today than it was back in September. And that doesn't mean I don't think Trump's going to do a good job. What I am saying is probability of a sell-off is higher today. You know, we're all very fortunate. You know, there's probably no one in this room who was alive in 1929. You know, we're fortunate because when markets sell off, they tend to bounce back fairly quickly, strengthening the conviction that long-term investing pays off. But they don't always bounce back. In 1929, a lot of us forget the market went down almost 90%. That's 90. What a lot of other people forget is it didn't recover its October 1929 high until 1953. That's 23 years to recover. More recently, the Nikkei hit an all-time high of about 38,000 in 1989, and today, over 25 years later, it's at half its all-time high. So let's talk about why I think there's a greater probability of a market sell-off. And let me just say that tail risk is something that everybody always needs to have in the back of their mind. What I find very interesting is most people have homeowners insurance. And why do they have it? They have it because their house may burn down. Maybe someone's going to slip and fall and sue you for $1 million. I don't know anyone, I'm 55, I don't know anyone whose house is burned down. I'm sure it happens all the time, but the probability of your house burning down is extremely low, and the probability of you getting sued because someone hurts themselves at your house is really low, but everybody buys homeowners insurance. The probability that there's going to be a major sell-off in the marketplace is there. I think it's greater than your house burning down, but most people don't understand it and are not prepared for it. You know, I mentioned I think the probability of a major market sell-off has increased since Trump got elected. Let me take a step back and just say I also think the probability of the economy improving and of the stock market doing well it has improved because of a Trump presidency. I think there are a lot of goals he has that are very positive for the stock market and the economy. You know, his infrastructure spending should help the economy. Less regulation should be good for companies. It should help the economy. Lowering corporate taxes should make our companies more competitive globally. That should help the economy and the stock market. Negotiating better trade deals should help our companies and help the economy. And I think that the greatest thing that Donald Trump does is despite the fact he got less than 50% of the vote, people that like him love him. I mean, he has a cult following. I don't know who saw him speak in Ohio over the past week, but I mean, the guy fills stadiums, and the people that show up love the guy. I mean, they are optimistic, and when people are optimistic, they will spend money, and that is good for the economy. Donald Trump is going to bring change, and hopefully that change is great for our country, but it's not guaranteed. You know, he may not work out, and if he doesn't work out, it's going to be very bad for the capital markets. You know, he's at a big disadvantage. Compare him entering the presidency versus Obama. You know, when Obama took over, Federal Reserves around the world had tons of dry powder. The capital markets were really cheap. The equity market had just sold off. Stocks were trading well below intrinsic value. On the bond side, credit was yielding very high levels. And when capital markets rally, people have more money to spend, and it helps the overall economy. You know, with Donald Trump, he doesn't have that. You know, monetary authorities around the world have very little dry powder. If we go into a global recession, it's going to be very difficult for them to bail it out, and we could experience a much worse recession than normal. If you look at the capital markets, there's still a bubble in bonds. I mean, it was absolutely ridiculous that trillions of dollars are trading at negative interest rates for countries that are running up government deficits. Just did not make any sense, wasn't sustainable, it was propping up the equity market. Since Donald Trump has been elected, the equity markets have done well. People have forgot why equity valuations were above the historical averages. They're now focusing on increased profitability of companies, but at some point, if interest rates keep going up, it could put a lot of pressure on the equity markets. You know, this is especially true for pension funds. Pension funds are under, and we just wrote a paper in November about pension funds and hedge funds. Pension funds are under a lot of pressure to get out of hedge funds. There are some people that view all hedge funds as bad, all of them. This is at a time when the average pension fund is around 74% funded, based on a study by Wilshire Associates. The problem with that study is to calculate unfunded liabilities, you have to take your future liabilities and you have to discount them back at an interest rate. And the higher the interest rate you use, the lower your unfunded liabilities are. The average interest rate pension funds are currently using is 7.5%. Most people think a 6 to 6.5% is more realistic. You know, it used to be that public pension funds and corporate pension funds had the exact same discount rate. But the government said, you know what? We got to do something about ERISA corporate-based pension funds. So about 10 years ago, they forced corporations to use discount rates that are tied to the yield curve. So corporate pension funds today are using a discount rate of around 4.5%, where the average public fund is 7.5%. So if you lower the discount rate of public pension funds, their unfunded liability would go up a lot. And as a matter of fact, there are a number of public pension funds that cannot withstand a major market correction and continue to pay benefits. They would have to get additional funding from whatever the municipality they're associated with at a time when these municipalities have the least ability to make pension fund contributions. You know, in my career, I've had a very large percent of the largest pension funds as clients of mine. When I was at Merrill and B of A, I've been on investment committees for pension funds. I'm on the investment committee for endowments and foundations. And I can tell you they do not understand tail risk. They don't even think about it. And their models they use are flawed. And the reason they're flawed is because this is what happens. You know, at least once a year, a pension fund sits down with their investment consultant and goes over their asset allocation. And their objective is, which is a good objective, is to have the highest return for a given level of risk, or to be on the efficient frontier. And how do they do that? The first thing they do is they identify all the things they're going to invest in. You know, small cap equity, large cap equity, non-US equity, high yield, core fixed income, on and on. And for every one of those asset classes, they work with their consultant and they come up with forward-looking return assumptions. They also come up with volatility assumptions for every asset class. And the last thing they come up with is correlations of the relative movement of various markets. And they put all this into a computer, and what the computer does is it spits out, you know, an optimized portfolio. If you want your standard deviation of your portfolio to be 8, this is the asset allocation we recommend. They then compare that to how they currently are invested, and they will make shifts in their asset allocation. The flaw with this model is that it doesn't properly measure tail risk. And the reason I say that is, just think about the variables. One variable is correlation. I can tell you that when markets sell off, correlations go to 1. So these pension funds are not as diversified as they think they are. Another variable used in this mathematical equation is, what is the volatility? Well, what happens when the market sells off? Volatility goes up. That is not good when the markets are going down. So a lot of these pension funds have significantly more tail risk in them than they realize. And this is where hedge funds can help. You know, you don't measure all hedge funds by the S&P 500. There are certain hedge funds that when markets sell off, they actually become negatively correlated to the capital markets. For example, a lot of CTAs, if you have a prolonged sell-off, become negatively correlated to the capital markets. You know, there's a lot of strategies that have no correlation to the capital markets. For example, reinsurance. You know, if the equity market sells off, it doesn't cause more hurricanes and earthquakes. Obviously, there's market neutral equity, relative value fixed income. I can go on and on. But there are a lot of strategies that pension funds should look at that have no correlations and can help protect in down markets. They just need to understand what the benchmarks are for those strategies. You know, the second way hedge funds help, and why a lot of people invest in them, is because they enhance the risk-adjusted return of a diversified portfolio. And I want to go back to pension funds again, just to give you an example of this. So with a pension fund, you can't have all your money in equities. It has to be diversified across multiple asset classes. And I mentioned for each asset class, you have to come up with a forward-looking return assumption. So for core fixed income, you know, as of the end of the third quarter, the aggregate index was only yielding around 2%. You know, we've had a sell-off in fixed income. Maybe it's up another 50 basis points or something like that. But for your forward-looking return expectations for a core fixed income portfolio, you can't be using much more than 3% that your long-only managers are going to generate after fees. Hedge funds, to add value to a pension fund, don't need to beat equities. All they have to do is beat bonds. Bonds are, you know, 3% forward-looking return, and there's a heck of a lot of risk in long-duration fixed income portfolios. The last reason people invest in hedge funds is basically best in breed. And, you know, I think there's an evolution of why, you know, pension funds are allocating to hedge funds. Some of the more sophisticated ones, they start with, you know, fund of funds, and then they buy the largest, best brand managers, and then they go to smaller managers, and eventually they don't look at it as an asset class. They look at it as just a fund structure that is made up of a lot of different investment strategies, and they compare those managers, just like a lot of endowments and foundations, to long only. So, you know, at some point you're going to see pension funds, you know, in their fixed income portfolio have PIMCO, WAMCO, BlackRock, along with maybe a direct lending fund, a distressed debt fund, and so forth. Obviously, the benchmark for that strategy has to be very different than what the S&P 500 is. You know, enhancing equity returns, that's fine. Maybe you can use the S&P as a good benchmark, and at some point it's looking at equity managers alongside activists, sector managers, and long-short equity managers. You know, the key is you really have to understand why you're investing in hedge funds, and different people invest in them for different reasons. And whatever your reason is, you have to invest in those strategies that are most likely to achieve your goal, and you have to have a benchmark that effectively measures how well you're doing, and using the S&P 500 in most cases is not the best benchmark to use. I want to address a couple of the issues raised by the press about the hedge fund industry. And again, not everything is rosy in the hedge fund industry. I mean, we do need to evolve. There is no question about it. But the first thing I want to talk about is there's been a lot of criticism about bad performance in the hedge fund industry. And in order to say it's bad, you also have to say, you know, what are you comparing it to? And as I mentioned, comparing it to the S&P 500 does not make any sense because most hedge fund strategies don't have high beta exposure. But one of the issues is basically, how do you calculate hedge fund performance? What are you using to describe how the hedge fund industry is doing? And what most people use is indices. And the problem with using indices is that, you know, there are 15,000 hedge funds, And someone else mentioned this today. They thought that 90% of hedge funds were not worth the fees they charge. And I agree with that. I think 90% of hedge funds are not very good. And there's people in this room that may say, wow, that's so terrible, Don. Why do you say that? Well, I think it's actually positive. It means that 10% are good, which is 1,500. You know, if you ask some of the pension funds, they don't think any are good, 0. Let's get rid of them. The second thing I think affecting hedge funds is that, you know, I got in the industry at the turn of the century, and when I did, the total assets in the industry were about 600 billion. They've gone up over 5 times since I first got into the hedge fund industry. And, you know, there's no question that there is an inverse correlation between assets and returns, and it affects some strategies a lot more than others. And I think it's, you know, I don't think hedge funds are going to generate the same returns today as they could have in the 90s when you had a lot less money going after these strategies. With that, I still think hedge funds can add a lot of value to a multi-asset class portfolio. Another issue with the hedge fund industry is that most of the money is going to managers that are the largest with the strongest brands. You know, I think that is going to get you mediocre returns. As I mentioned, there is an inverse correlation between asset size and performance, and there's a lot of hedge fund managers today that have way too much assets, and the alpha they are generating is diluted over a larger asset base. I mean, the business has really changed. When I first got into business, people closed all the time. I mean, you had to move to get into a fund before it closed. Where after 2008, very few funds closed. They just keep getting bigger and bigger and bigger. Right after this, we're going to have a session on emerging managers, so I don't want to steal all their thunder. But there have been studies that show that emerging managers or smaller managers outperform larger managers. And I actually think that the studies are somewhat flawed. And the reason they're flawed is this is how they calculate them. They take an index and they break the index down based on the size of managers, and they get all the big managers and put them over here, and they get the average return. And they get the small managers and they get the average return of these guys, and they compare them. And the small managers do better than the large managers. Why I think it's flawed is because when you get to big managers, most of them are pretty good. I mean, they got good teams, they got good processes, they got risk control, service providers. That's why they're big. Their only problem is they've taken too much assets, which is reducing their returns. When you get to the small managers, a lot of them suck. You know, I mean, through research and due diligence, it's very obvious you can weed a lot of those guys out. So if you weed 75% of them out, and you're just left with 25% that you think are pretty good, and you look at the performance of them, I think they are going to generate much better returns than larger managers. The last thing is, you know, returns have come down because the capital markets are expensive. You know, in 2009, it was not hard if you had beta in your portfolio generating strong returns. Interest rates have come down significantly. The carried interest in hedge fund portfolios has come down. It's just, you know, very difficult generating strong returns in a low interest rate environment. It doesn't mean they still can't add returns. It just means that relative to 2009, returns should be lowered. You know, back in 2009, when we were taking managers around, most people wanted kind of mid-teen returns. And if you couldn't get that, they really weren't interested in your strategy. I mean, you could not sell market neutral equity in 2009. It was almost impossible. You know, 3 years ago, if you couldn't generate at least a 10% return, people didn't want to talk to you. Where today, I think there's a lot of people out there that are looking for kind of a 6 to 9% return. That may not describe you guys, but I'm telling you, there are a lot of people that are happy with that. And most of these pension funds that are allocating to hedge funds, you know, when they do their models, they're looking at like a 4 to 6% return in hedge funds, which I think is very doable going forward. I also want to touch on fees. You know, there's been a lot of pressure on fees. A couple years ago, we wrote a paper that said that the average fee that hedge funds were collecting was significantly below the average reported fee by hedge funds. And that's even more the case. This is a trend that is not going away. You know, when early in my career, I used to work for a very large hedge fund, and when I did, I think we had like a 3-year lock, and we had huge fees, and you know, one of the largest pension funds in the world invest with us, and I mean, there was no flexibility. It was like take it or goodbye. Where that's gone. You know, There's been a lot of criticism about pension funds paying 2 and 20 fees, these huge pension funds. And I mean, yeah, maybe there's a couple hedge funds you should be paying 2 and 20, but if you're allocating $75 to $100 million for hedge funds, you should be paying a heck of a lot less than that, especially if you're using small or emerging managers. A lot of these institutions are effective in negotiating management fee. They're effective in negotiating performance fee. We've begun to see an increase in hurdles. We've begun to see, some negotiate the time frame of the crystallization of performance fees. But we've also seen a lot of institutions give up something, locking up their money for a certain period of time in order to get this benefit. And I think this pressure is just going to continue over time. With 15,000 competitors, there's a lot that are willing to negotiate fees. The biggest mistake is investing in a manager just for fees. They should be, all things being equal, you should focus on fees. You should not be allocating to the cheapest managers out there. Other pressure on fees are obviously with small and emerging managers. I mean, it's tough out there. There are 15,000 hedge funds, a majority of them have less than 100 million, and only 5% of assets are going to managers with less than 100 million. So a lot of these managers are being forced to discount their fees, and I'm not going to go through it now. I'm going to cross this out because you're going to hear about it in the next panel. And then there's 40 Act. 40 Act or management fee alone. Now, most of 40 Act investors have been retail. They haven't been institutional. And I think the performance for 40 Act have been pretty disappointing. But there's a couple out there that are pretty good, and they tend to work best with liquid strategies. This negotiation of fees, I think, is a glimmer of hope for the fund-of-fund industry. I mean, the fund-of-fund industry has been under intense pressure since 2009. And the good thing about negotiating fees is most people that are allocating 1 to 10 are not able to negotiate fees. I mean, they on average, if they don't invest in founder share or small firms, they're paying traditional hedge fund fees. But if they invest in a fund-of-fund, a lot of these fund-of-funds are able to negotiate very big discounts, and they can go to their investors and say, we used to be criticized about double fees, but you're not paying double fees with us. We're negotiating, we're saving you more money for the managers you're allocating to than our management fees, so basically our expertise is free. So let's say you don't invest in hedge funds, which everybody in this room is associated with hedge funds. But why should people care about the hedge fund industry? There's a bunch of reasons. The first is they help with economic growth. I mean, they supply capital to small and mid-sized companies that are having difficulty getting capital. I mean, banks have pulled out, and small and mid-sized companies produce most of the jobs in this country. And it's the hedge fund industry and private equity industry that are providing valuable capital to these people that are helping the economy. Another reason that people should care about the hedge fund industry is that they provide liquidity to the marketplace. They buy a lot of stuff that no one else is going to buy. That is a valuable service to the global economy. They also keep markets liquid. If markets seize up, global economy comes to a halt. And the hedge fund industry is very important. It has stepped in to fill the role of investment banks. They also make economies and companies more efficient. It used to be that a lot of management of companies would run their company as their own little fiefdom and didn't really care about return on investment and had multiple private jets to fly around in and all sorts of nice lodges for the management team to go to. And today we have, a lot of prominent activists, and not every story about activists is positive, but in general, they help make the economy and companies much more efficient. We're in New York City. Most of the major nonprofit organizations, let me use the term many instead of most, have hedge fund people on their boards who are major contributors. Hedge fund organizations are very charitable. And last, the hedge fund industry obviously employs a lot of people, pays a huge amount of taxes. When the city of New York pulled out of hedge funds, a senior official with the city of New York was quoted as saying that hedge funds should sell their houses in the Hamptons and should sell their private jets and give the money to pension fund beneficiaries. And it's a very unfortunate thing that they would say something like that because, as I mentioned before, there's 15,000 hedge funds. A majority of them are less than 100 million. Only 5% of assets are going to small hedge funds, and they're struggling. They're barely making a profit. It's very competitive, very difficult. Most of them are never going to be successful. When you think about it, investors use a funnel approach to allocating to hedge funds. And I'm going to talk about this funnel approach just so you understand how competitive it is. You know, if you are a professional hedge fund investor, you are being contacted by thousands of managers a year. You're meeting with 100 to 600 a year, depending on your organization. You're doing follow-up meetings with 50 to 100 a year, and you're allocating to 2 managers. It is a process of elimination where they are looking for one little teeny thing to knock you out. I'm just about out of time, but we did another presentation about 6 months ago. And at that presentation, I gave a 30-minute presentation on what the 3 keys to raising hedge fund assets are. And I can tell you that if you have these 3 keys and you're a small manager, I guarantee you are going to be successful in raising assets. And those 3 keys are a strong product. And when I say strong product, you know, we get contacted by hundreds and hundreds of hedge funds a year, and I have some that will just send me an email saying, hey, we got this phenomenal track record, here it is. And I can tell you the people with the strongest track record are not getting a majority of the assets. It's people that rank well across multiple factors. So you need to have strong performance. You need to have performance that ranks in the top decile or top quartile funds in your strategy, but you need to have a heck of a lot more. You have to have a strong organization, strong investment team. You have to have a process that people understand what the inefficiency is you're going after and what your differential advantage is to capture that inefficiency, risk controls, performance, and you also have service providers. And when we look at managers, and when we hire a manager, often I like to see someone who just has one little blemish, just one little thing that I know if we fix, it's going to go from not raising money to exponential growth. The second thing you need is you need to have a great marketing pitch. Now, I'm not talking about sales schmoozing. I'm talking about a pitch that is very concise, very linear, talks about each of the evaluation factors investors use to select hedge funds, and clearly describes what their differential advantages are across each of those. The problem with most hedge funds that have great products is they are bad presenters. Most of them think they're great, but they're not. They go around and they meet with people, and they don't get any money, and the reason they don't is because people's perception is below reality. And if it's below reality, you're not getting hired. And the third thing is you have to have distribution. You know, you have to build a brand. You need to penetrate that marketplace. If people, just putting your numbers in databases, assets aren't going to come. They used to come in like 2006. They don't today. If someone hears about your fund from someone else, it is much more powerful than if they just hear it from you. So with that, I'm going to conclude my remarks, and I want to thank you all for coming to this conference. Thank you very much.